Hey everybody, it's Michael Martin. Thanks for being here. I have my good buddy Brian Shannon on today. Brian, how you been today? How you been, buddy?
Good, things are good. What a hot market we have, huh? It's kind of crazy.
It's been a really good market. It's definitely harder for me because I'm more trying to build into positions, which we're going to talk about. But I have been finding myself like day trading and swing trading because in many ways, it's a make it and take it market. Anyway, for those of you who are new to the show, which is probably the majority of you, Brian wrote an amazing book called Anchored VWAP. Don't say VWAP or I'll call you out for making an ethnic slur. Wrote it about a year ago. He's been on the show before. I've known Brian for 20 years. And for those of you who are discretionary traders, which is again the majority of you not using, say, Mechanica or trading blocks to build a purely mechanical, systematized approach to trading, this is as close as you're going to get to um, helping you come up with a strategy to really understand two things that I think are very, very important if you're going to speculate in stocks, and that's supply and demand. Institutions, Brian and I are both friends with Scott Kaminsky, who's famous for saying, institutions leave footprints. You know what I'm saying? So, Brian, welcome back to the show. I'm really looking forward to speaking to you about a tactical approach, to trading. I want to, there's a saying that there's old traders, there's bold traders, but not a lot of old and bold traders.
Right.
And I think what's great about this book, you can emphasize this, is um, when you use your strategies in here, it helps you understand when you can actually be bold and then when you should actually back off. Is there truth to that?
I think so. And the cornerstone is always, your risk management. And even
Yeah.
if you're going to be bold, it doesn't mean throw caution to the wind. It means, have your chute ready in case something bad happens and a big gust comes up.
Yeah. I mean, I've actually tried to incorporate a lot of this. We're going to go over a couple of examples. There's so many trading strategies that you can use with Anchored VWAP, including how do you, join an existing trend? How do you trade gaps? How do you look at short squeezes? Now, today is Friday, February 23rd. Carvana is getting squeezed today. And I had a small piece on, of course, not enough, but I can call up my chart. You can call up your chart, or
Hmm.
we can just, but what I looked at was it was coming out of the pinch, as it's called. But then I waited it to cross the 5 day. And I know you're a stickler for the 5 day. I kind of heard your voice in the back of my head going like this. But is it smart to marry multiple indicators with the anchored VWAP, or is it kind of good enough on its own? What's your take on that?
I'm not 100% purist about the anchored volume weighted average price. In
Yeah.
fact, the 5-day moving average is my number one
Oh,
intermediate term indicator.
yeah.
So that to me, so regardless of what the volume weighted average price is, if a stock is below a declining 5-day moving average, I'm not going to buy it. If it's
Yeah.
above the advancing 5-day moving average, I'm not going to short it. So I think you have to understand market structure as a whole to begin with,
Yeah.
and then use the short-term supply and demand dynamics based around anchored volume weighted average price to really hone in and get your plan really tight.
Yeah. Yeah, on the discretionary side of my practice, I try to mix and match stuff. I take good notes, of course, too. There's lots of chart patterns, but I try to find out for sure who's in control of the instrument, right? I do not want to be buying, like we'll talk about this. One of the things that you can use this technique for is to understand like pullbacks. Sometimes maybe you sell a house, you come into money. Now your account is flush with cash, but the market's been moving. So how do you join an existing, move? How do you join if you're a short seller? How do you, time your put purchases? How do you enter short into a protracted downtrend? Or, with some of the names that have been screaming, especially in the chip sector, how do you join, right? Can you use anchored VWAP as an overbought, oversold indicator, Brian?
I can give you a perfect example with a screen share of a trade that I took just about 20 minutes ago.
Let's do it.
So let me find that share button. Here it is. And we're going to go to Trading View.
Okay.
And where I've got it. Oh, there, share. Okay. So here on TradingView, I've got this dialed into a 1 minute chart right now. Let me back it up a little bit and
Okay.
go out to a 5 minute time frame, because what I want to show here, Michael, is, we just had earnings in the stock,
Right.
and the earnings report came after the close. That was right here.
Yes.
So as soon as the earnings come out, what do? I put an anchor to that point, because that's a catalyst that changed the supply and demand dynamics.
Yes,
It's
sir.
something that got everyone's attention. The stock rallied huge, and up until today. So this is the post market. This was the pre market yesterday. This is trading yesterday. This is last night's post market.
Right.
This morning's pre market, and this is today, Friday. So Friday we had the market gap up a little bit, based, from the 4 p.m. close, and then we started to sell off below the volume weighted average price. So while it's below the volume weighted average price for the day, I don't want to be a buyer of the stock, because it says for today, the sellers are in control, and I'm not going to buy the dip. That's what I always preach that. Don't buy the dip, buy strength after the dip. So here's that blue anchored volume weighted average price from the earnings report. And you can see, and actually when we go down to a 1 minute time frame, you can see it nailed it. I mean, you just cannot make that up.
Yeah, it's great.
There are programs there. So I didn't buy the touch of the volume weighted average price. I never do, because there's nothing to guarantee it's going to slow down there. So it's not a throw caution to the wind level again, but it's a level of interest. And it has my interest because it says to me, here's where the supply and demand dynamics just shifted. And by the way, I put this on Twitter just as it was touching this level. I think it was about 779.5. So this isn't a hindsight trade. This is actually, out there in the public. So it rallied a little bit. I purchased right here, and my intended stop was below this low. To me, it defended it. It rallied away from it. If it breaks below there, I'm out. I got a little nervous over here
Yeah.
because I bought more than I probably should have.
Yeah.
And in fact, I didn't even buy this. I bought NVDL, which is the 1.5 times long. But I trade it based on this chart on the underlying. So I bought right in here as it was rallying away from it. I've sold some right in here at this point, and I've got a 2/3 position left. I don't really have a price target, but I think it's possible it can make it up to the number. And if it instead breaks below this little low, this is my most recent and relevant higher low. So we have this high, we have that low, then we have a higher high. This is the higher low. So my definition of anchor from the day, or maybe that at least that round.
Mhm. Mhm.
Trend on this very short-term time frame is if it breaks below there and I'm owning it down here, I have no business being long if it breaks down below that. Now, if it breaks above this little peak here, let's just call it 797. If it breaks above there, my stop goes up underneath this, because this is the most recent relevant higher low. And I'm doing this right now on a 1 minute chart because that's the opportunity in NVIDIA for a trader. I'm not looking to make an investment here. This is a day trade.
Understood. Yeah, I mean, as charts go, this is a Playboy model right here. This is unbelievable.
You can't make that up. Look at how it touched
look
it
at-
to the penny.
No, you
There's
can't. You can't.
institutions that
Yeah,
want to buy a bunch of this, and they say, wait a minute, we're not going to chase it. So we need to buy this stock over the next week, next month, whatever it is. As it pulls back to the average price since the earnings report, that is so-called fair value. That's where we're willing to purchase this stock. So we've got bids in at that level.
yeah, and that's an important thing. My show is largely about
Yeah.
keep
So
this
I'm
up
just
if you
going to
don't
point
mind.
out here that now my stop goes up under here. We just made a higher high. This is the most recent relevant higher low.
Yeah.
And yeah, it's on a 1 minute chart, but look at how many points it is. I've got
Yeah.
to protect that.
Yeah, that's awesome. That's really good to see. So now you'll just see if it trades up to the upper boundary there, just the 802 or whatever that is, and see how it behaves. If it comes off and starts to
I'll
reverse,
most likely sell
you can
half of
protect.
my balance. I have a 2/3 position left. I'll most likely sell half of what I have right around that 800 round
Yeah,
number.
understood. So can we talk about this for a minute? This is kind of coming just from the spontaneity of the chat. When you think of like a scalp, do you have a different do you differentiate between a normal position size, like one that you would take home overnight over the weekend versus a scalp unit? Do you differentiate between, or you kind of constant use a constant
That's a
size
great
for
question.
everything?
Now, on a stock like Nvidia, where the liquidity is unbelievable and the volatility is huge, that you can get in a day trade the types of moves that you would normally get from a swing trade. I go in a bigger size here. I don't mind taking the risk on the day trade, especially when it comes down as it did here perfectly to a level that I have a lot of confidence in. And we know already that, the fundamentals were super strong. And I know that there's fundamental buyers in there. I
Yeah.
don't really care what the numbers are, but I know that there's people who care about those numbers who are going to buy up as much of this stock as they possibly can down near that anchor.
Yeah. So to me, this is a great conversation because that's what I typically do. I call it doing judo on the market. I understand the fundamentals. I'm probably 50-50 commodities and stocks, but I don't poo-poo what other people's models, right? So I try to figure out where are the other are the sorry, Brian,
We all do,
sometimes I
yeah.
have a tough time saying what I want to say. I'm absolutely concerned in trading the crowd. I've said before, my one of my favorite books is Extraordinary Popular Delusions and the Madness of Crowds. Like, I know I'm small. We have a lot of money under management, but I'm still small compared to everybody else. And those people, if they decide to hit the sell button, they can put your lights out in 3 seconds. So I've been risking 0.5% recently with this type of market. Again, I'm taking things home overnight over the weekend, and that kind of fits me for where I want my money to grow. But also, like, if things work against me, it's probably, for talking to a guy who's was in long cattle when Mad Cow hit the
Mm.
tape and it was locked limit down 5-6 days in a row. I think I spent a lot of time looking at um, position sizing all day long. What just not dollar wise, but percentage wise, what are you typically comfortable risking on a per trade basis on something like this? Is it two
No, it's
percent?
closer
Is it a half a
to,
percent?
25, 30 basis
Y-
points. My risk is so tight in
I
there
see.
that it doesn't have to be a lot. Now that's on a day trade. On a swing trade, it might be closer to that half to 1%, but I'm generally not going to put my theoretical risk at greater than about 1.5%.
Yeah, that's great. And so, folks, for those of you who are just starting out, you're talking to a guy who, yeah, he has a CMT, but all that information only matters
Right.
to the
Yeah.
extent that you can execute, right? Brian and I have been around a long time. We don't get paid necessarily to know stuff. We get paid to execute, you see? So sooner or later you have to kind of shit or get off the pot with what it is that you think you know. Gone are the days where it was, when we started, there was no internet, there was no mobile technology, so you had books. And so having like an encyclopedic knowledge of things helped because it gave you obviously total recall in the moment's notice. But nowadays everything's a Google search away. You have to be able to execute for everything that you know, everything that you absorb. Um, let's talk about um, setting the anchors because there is an art and science to it. You set the anchors here. Um, and you took into account the gap from where the earnings were announced and then today's high, which was 820 something and change. But I noticed on my technology, I'm able to use either the
Hmm.
open high, the low, the close, the high and the low divided by 2, the high, the low, the close divided by 3, or the average of the open high, low, close, but divided by 4. Do you get that fussy with setting your anchors, or
Yeah.
help me
No, it's
understand
a
that because
it's a
I
great
actually want to
question,
know
and
for
it's
myself.
something that's kind of misunderstood. The volume weighted average price, in theory, is the average price that every single share transacted at. Okay, so the only way to really get that is with a tick chart that represents every single trade. That's just not practical. It's just not practical
Right.
for
Time and
even on a
sales.
1 minute chart.
Right.
I mean, if you're day trading. So on a 1 minute chart, what do we want to know? We want to know the average price since it touched this volume weighted average price, for instance. So do we do the high and low divided by 2? And how much of that volume occurred at the high, how much occurred at the low? Does that give us an accurate measurement? The most accurate measurement is all the data, tick chart. The second most, and what's practical to use, is all the data we have access to, open, high, low, close divided by 4. There really should be no other option. I see some people who just use the high or just use the close. You're throwing away 90% of what happened, even on that 1 minute chart. Where does the average price occur?
Gotcha.
And open, high, low, close divided by 4 should be the only option available. No one should use anything else, period.
Okay. Because there is a little bit of an art and science to picking the actual anchor days, right? Then you can, fine tune it, folks, with, looking at these prices. So, um, to me, by marrying, people, I've said, you've said, Bella has said, right? There's a million people who do this, where we speak and say, look, if you can't define your trading edge in many ways, you really don't have any reason to put risk on. Of course, when you're trying and you're starting out, you need to do some experimentation. Obviously, know what your max loss is, but to me, by marrying price, time, and volume with your own position sizing algorithm, I think this can give you an absolute trading edge in knowing when to trade, knowing when to sit on your hands.
It's
What do
definitely
you
my
think about
edge.
that?
That's I mean, that's how I use it. It's to hone in on something like this in NVIDIA and say, here's a key level of interest at the anchor from a huge catalyst. The huge catalyst, so where do I anchor from? Well, where
Yeah.
did, what's the catalyst? What changed the opinion of the people who are participants in this market? And it was the earnings report so if we want to know the supply demand factors from that point, as long as we're above the anchor from that point, it means the buyers have control since the earnings. As it comes down to that level, it's just a simple place to be aware and look at it as a level of interest. The daily volume weighted average price is my level of interest on the upside. It's not necessarily my price target, but it helps me define my edge and say, okay, if I'm buying down here and my risk is under there, it's possible it can run back up at least to the daily volume weighted average price. So that's a huge theoretical risk reward. That's about a 1 to 8 risk reward. And that gives me my edge and tells me exactly where I want to be involved.
In our mastermind, one of the first lessons that I talk about is, you know, what makes sense for you from a risk reward standpoint. So I'm really glad that you said that. You said 8 to 1. It might come as a shock to some people, but I'm not really interested in 2 or 3 to 1. So for me,
Mm-hmm.
the baseline is 5 to 1 because I figure, even with everything that I know and everything that I learned from, mentors and the guys that I've worked with in, say, the first Market Wizards book, I always feel like I'm the idiot in the crowd. And I know that might sound weird because I do a lot of shows and I speak a lot about emotional intelligence and this and that, but those shows are actually like a flow of consciousness of my own thinking, remembering all the dumb mistakes that I made. So when I'm able to kind of, it's hard to read the tape anymore, right? Back when we
Yeah.
started, things were in eighths and it was a lot easier if you had a level 2. Now, to me, at least for me, I find it very, very difficult. So much so that I've basically abandoned
Likewise.
the process, and I was pretty damn good
Likewise.
at it
I
back in
pay
the
almost
day.
no
Huh?
attention to level 2.
Right. So it meant something back in the day. But when you look at, like, for the risk that you're willing to take, how many multiples of that can you get paid? So for me, I figure if I'm an idiot and I'm going to be wrong 70% of the time, if I can fill my portfolio up with it when I'm accurate, say 30-40% of the time, right? Because it varies when you have winning streaks and losing streaks. If you can fill your portfolio with these 5-to-1, 8-to-1 type of trade-offs, you're cooking with gas. Like you're gonna do very, very well as a trader. And I think what Brian was kind of saying and I don't mean to put words in your mouth, is that by using this technology, it helps instill a sense of patience, right? That you don't overtrade, that you don't have FOMO, right? You have to temper that obviously and go through that. But what do you think
Having
about that?
structure around your trades, is going to prevent or
Yeah.
minimize the impact of emotions. And people are of various camps saying emotions are the enemy. Other people say you need to feel your emotions. You need to listen to the feedback that the market's giving you physiologically, mentally, etc. I am not good with emotions in the market. So I need to have these guidelines to hold me in place to say, if it bounces from here, then I'm going to purchase. If it breaks back below there, then I'm going to get out, because that emerging strength that I was maybe imagining is not there. As it makes the higher low, I put my, right here, I put my stop under there. As it makes this high, stop goes under there. Now my stop goes under here, and I'm looking to sell half of my balance really soon here. I'm getting very itchy actually on the trigger to sell half of that balance that I have left, or a third of the original position, because it's approaching that level of interest where it's likely to find supply. I look at it and say, where has it come from? Well, it just came from 776 up to 799. We've just ran 23 points in 35 minutes. Where does it have the potential to go before it's likely to encounter a source of supply, which might become resistance? We don't know where resistance is till after the fact. Well, the daily volume weighted average price is that level. So we're closing in on it very rapidly. So I don't understand people who buy here, what their risk reward is when they have the potential for resistance right in
Yeah,
here.
exactly.
Fortunately, not everyone understands this stuff. They just see momentum and chase it. Now's the time to say, I'm going to get really tight on half of what I have, take that third off. I took my first third off over here to satisfy
Yeah.
my, uh, uh, you know, desire to take some profit and to reduce risk, because I put a lot of risk on down here. I need to take some off to breathe easier and talk to you right now without having to stress about that. But it's
Yeah.
it's just about time here to sell half of my balance.
So, folks, for those of you who like to
There
stay
we go.
within
I just
trading
sold it.
ranges, this is a
I
systematized
just
way to
sold.
kind of do this.
Is it crossed
Well,
800? I just sold half of my balance. I don't know if you heard the little ding. That was the execution bell. Oh,
I didn't hear it, but for whom the bell tolls, Brian, good trade. Um, this is a systematized way to kind of trade the bounce without getting into guesswork here, right? Because you can certainly get tied up. This is one of the darlings, of Wall Street now, that even my dead grandmother has a story on Nvidia. So let's just say that it crosses over the line there at about 800 and 802, whatever it is. Would you wait for it to kind of retrace and then bounce off the upper boundary then, and then on that
I think
retracement maybe
that what
consider
it's
going
likely to
long?
do is, if it gets up through that level, I'm not good at drawing on here, but maybe it does this, has a little shakeout below it, and then, I here's the thing is, if it were to kind of consolidate around it a little bit, and then I would really like to see a little shakeout, maybe down to the anchor from the beginning of this move, and then buy strength away from that
Right.
with a stop very tight from there. But I wouldn't do that trade with as much size. So in other words, if I were to buy some right here,
Mhm.
it would be maybe half of the risk unit I took over there, because this was the big important anchor from the earnings report. This is just a little
Right.
handoff anchor. And, that's just less likely. I think we need to digest this move a little bit that we've just seen. 25 points in, just as many, or just about an hour is, that's a good move even for an $800 stock. Yeah.
It's a 3% move in the underlying. So that would be more of a pinch type of trade then, because in the book we have lots of examples, folks. Brian and I are kind of talking over it, but when the lines kind of start to
Right.
converge, the tighter the pinch, the better, right? So you would. Can we look at Carvana then?
Yeah.
We'll talk about a short squeeze. I don't want to keep you all day because I know you're busy and you were
Let me
both
go
in the
to a
middle of the trading
15-minute
day.
time frame for you.
Because I was,
Yep.
and it's legit. I sent Brian the confirmations. I I don't like making bets on just before earnings, although I did it twice this week. I just trusted my gut, and luckily I got away with it. Um, so coming in after the close yesterday, Carvana announced. I always know this name because it's on one of the most shorted. It's in the top 20 of the most shorted stocks out there. So there's, and I've made a lot of money with this in a squeeze. In fact, if you go back to the last show that we did a year ago, I'll put a link to it. We talked about using Anchored VWAP
Mm-hmm.
and marrying that with short interest, which there's a whole tactical chapter in the book about how to do this and, short interest coverage ratio, how many days. And you can get this type of information from, I know CBS Market Watch, if that's what it's called, has it. NASDAQ publishes it, but you have to be a pro subscriber. Koifin, which I don't have a financial relationship with, publishes it with the chart so you can kind of see where the shorts adding the shares or removing shares based upon the price. So I knew that there was a squeeze potential. So that's where my judgment kicked in. I waited because I knew if I anchored from the prior high to the gap, that we were in a bit of a pinch. And so once the price crossed over that upper boundary, which I think it was probably like 52, 53, it was still below the 5-day. So I was sitting there. They had already announced the market started to move. I got filled at like 59, 59, almost $60 the share in the
Mm-hmm.
aftermarket, like 15 minutes afterwards. But I wanted to wait and
Sure.
not be, I can be impulsive. That's not beyond me. But I knew that the squeeze was going to be on because I've already made a lot of money in the squeeze back when the thing was trading like $7-10 a share. And so I like to make this type of a trade because to me it's not easy. There's no easy money. But was I wrong for waiting for that 5-day moving average, or should I have gotten it right above the upper boundary from
The
the
way I always
high,
do it,
from the
Michael, is
high
to
then the
look at
high
that
anchor?
5-day moving average and try to anticipate the direction of the 5-day moving average. So if I see prices moving higher, I go
Yeah.
back to where we were 5 days ago. And let me just switch the what I'm sharing here and see if I can. How do I do that? Stop. Oh, stop screen share. So let me share my other screen, which will show you a little bit more accuracy how I view it.
Okay.
So on Carvana, for instance, you're talking about
Hmm.
the anchor off of this peak right here. And let's just actually, let me clear some of this other stuff up. So here's the anchor from that peak right here. That's what you're talking about.
It was like
Oh, the one
December.
for,
It was
on the
December, I
daily
think.
time
Yeah.
frame right here. So that's the daily on the left. Yeah, so we were
That was the one that I
cradling
was
that
looking at.
nicely. So
Yeah,
we,
yeah, yeah.
got back above it. It cradled it nicely. And then the high over here, the 5-day moving average was declining. I think that's what you're talking about. But
It was declining, and then after the announcement yesterday, I was watching the price kind of doing things in real time, and it moved so quickly that that's where I got I got a bet. I didn't get a great fill, but as they say, the worse the fill, the better the trade, right?
yeah,
Because it was it was like $2 a skid, but
the
that's
way
the
I look at
nature
it,
of the
Michael, see
beast.
this line right here? That's exactly where we were five
Yes.
days ago. Now let me take the post market off first. So this is where we were 5 days
Okay.
ago. So I look at that and I say, as we're getting rid
Okay.
of this data on this bar right now, at the end of in 26 minutes, as a new bar is created over here, this one drops off and it averages this in that moving average calculation. I think the easiest way to show it is to go to like a 1 minute chart and put a 10, so here we have a 10 period moving average on the 1 minute chart. And what happens is this is what we're averaging with this right now. That's why you can see that 10-minute average starting to rise as this does, because it's replacing that data, which is lower. So what I try to do is say, okay, if we're over here in Carvana the next minute, I know we're getting rid of this data. It's flat now because that's the same. So now we're starting to see it tick higher.
Right. They start to, yeah, yeah,
Then we're getting rid of this data and this data. That means that, so that, yeah, so I'm anticipating the direction of the moving average. And you'll start to see, as we are
fall
right
off.
now, that the slope of that increases more. And we're going to get a new candle here in 7 seconds. So we'll see that, let me clear my stuff off. You'll see that this line right here moves to right here, and there it is. So now we've got that. So this is on a 1 minute chart. And I only did that to kind of show people how to anticipate the direction of the 5 day moving average. Whereas right here, it was flattened out. And now we're starting to really see that rise more. And that's what I do by counting back on the 5 day and say, well, we're getting rid of this data. So, of course, that 5 day moving average is rising. Yesterday, we were getting rid of this data
Yeah.
and the stock was down here. So, of course, it was declining. But in the aftermarket, as soon as you saw it going up into this area where you
Yeah.
purchased, the 5 day moving average was rising for today. Right.
Yeah. Lucky for me, I can do that math in my head. So I was watching the price, knowing the thing was going to fall off. And I was like, okay, there's going to be a squeeze. This is the aftermarket. It's super choppy, so you have to have a cast iron stomach. It's something that I can't say that I do it all the time. And just to be completely frank with you, I had owned the 55 calls on Carvana a week or two ago, and I lost a 0.5% of my
Hmm.
capital on it. So not everything I touch turns to
No, of
gold,
course not.
but this one, did. So just to be objective
Me
here,
too.
I don't, it doesn't serve anyone to come on and just talk about all your winners. You know what I mean? So I do lose money, and I lost on the calls because I thought maybe it would spike in anticipation, knowing that it's always
Hmm.
a short squeeze candidate. So my ethos was
Yep.
wrong. My directional trade was correct, but ultimately you have to trade, as Brian and I say, only price pays. Everything else is bullshit. So um, I appreciate. I'm not the world's best day trader. I've kind of been forced into it just because of the nature of how there hasn't been a lot of follow through on a lot of names. But man, I can't tell you if there's any takeaway from the show here today with you is that the 5 day moving average has really saved my life in many ways. Knowing how to, I feel position sizing is of all the things. Position sizing is probably the most important thing that I bring to the table in terms of defining an edge. But then knowing not necessarily a sniper entry. I don't think you need those. You generally have to, have an okay entry, but the 5 day moving average has really saved my life and give me a moment of pause to not put on trades that I otherwise shouldn't have been in the first place, only to find the things, tank because they never achieved that level. And it's important for me, even with 36 years, to have that filter on because I'm not afraid of risk. I've made friends with all my feelings. So there's nothing that really psychs me out of
I
stuff,
mean, that's one of the most
but there
important
is a risk
discoveries I
on,
made in
risk
my
off rule
trading
for
years
me,
ago
and
is
that's the 5
the
day.
5 day moving average. And let me say something really quickly about that. A lot of people will say, well, simple or exponential. As you just said, well, I can figure that out in my head about the way the moving average works. Could you do that with the exponential moving average? What is the formula
Yeah.
for the exponential moving average,
Yes, sir.
right? That's why I use simple moving averages. I can see you replace this with that. There's no weighting,
Yeah,
there's no,
exactly. Yeah, exactly.
complicated formulas. So I always use a simple moving average. That's something that a lot of people
Yeah.
ask after, hearing something like this, but the answer is simple moving average for me. Easy, so
Yeah.
easy.
And you can train yourself to do it, right? You can train yourself to work with those bigger numbers. Like that's what I did. And back in the day, probably 20 years ago, I actually found a hack to do the exponential, the 20-day exponential, but it just became too much after a while. And I was like, you know what? It doesn't really serve me. And it's easier. I think you pick this up if you want to read another good book. It's called Simple Heuristics That Make Us Smart. And I won't get into the stories here, but it's a good way to kind of hack the data that you're looking at so that you can make, better,
No,
decisions.
no, no. That was just
So
to
you
show
use the
that was
10
actually just to
period
make the
on
example.
the one
But you
minute
can see
bar
here on
to
my
kind of
daily chart on the
anticipate
left,
what's going to
I've got those
happen.
same lines. So I can
Oh,
just
oh,
look
oh,
quickly
okay.
and say, that's where we were 20 days ago. That's where we were 50 days ago. That's where we were 200 days ago. So
Yeah,
I can anticipate because I know that there are institutions out there that won't
yeah,
buy with a declining 20-day moving average. They
yeah.
won't buy with a declining 50-day moving average. So if I can stack as many odds in my favor as possible, then that brings us closer to getting a successful trade where then if we're wrong, we can just risk a small amount and move on if the market doesn't agree.
100%. So in the book, Brian says something that I 100% agree with, and that is that short sellers are actually very, very smart people. If you look at the names that are on the short interest list right now, you can see they've cratered. Some of them are down 90%. So there's no sense in poo-pooing these people because they're terribly bright. But what I try to think about, how do they operate? Because I don't teach, I teach CFAs, um, and they're looking at valuation, right? They're looking at channel stuffing. So they're looking at fundamentals. Then they might even compare those fundamentals to whatever else is existing inside that sector. The technical analysis part really doesn't show up in their way of thinking, not even to use it as defense. Like you'd figure if it starts making a 20-day high or a 50-day high, you'd think that they'd want to cover, they'd buy calls, to hedge. And so, yeah, so for me, when they start thinking of valuation, it's like, my goodness, like how do you protect your capital? And what ends up happening is if you understand how trading works, there are breakout system traders who are either using systems and or looking at discretionary charts who are putting buy stops above the market. So when any time you see something getting pushed into a new high, you actually know that there's an enormous amount of buying pressure above the market. The way that you can filter that to just make sure is to use the Anchored
Right.
VWAP because it takes into consideration not just the price, but the volume and the time. Again, this to me further refines your edge to help you trade against people who have more resources than you. They
And they
have
don't
more
have
money. They
anchored
have teams
VWAP
of
on the
people looking
Bloomberg,
at
which is
research. They have,
insane.
Bloomberg's are what, 2,000 a month with a 2-year subscription, right? So
Oh, I was just, yeah, that's just the SPY. And
I
there's the
know,
5-day
I
moving
know,
average. That's
I
all.
know.
When it's
That's
below
that's
the
wild.
5-day
So what are we
moving average
looking
and the
at here?
5-day
We're looking
moving
at
average is
the
declining, I don't buy dips down in here. And some people will say, well, you missed this move. And the fact is, I did miss a lot of it. But, another chapter in the book, as you're aware, is don't chase the gap, wait for VWAP. So yesterday, the market gapped up and I don't chase those gaps. But as it gets back above the volume weighted average
yeah,
price, I bought right here, stopped below there. And we had a, terrific follow through. And I didn't have to have
yeah,
the uncertainty of the being below that 5-day moving average the day before because you look at this market and where we've come from overall and what people are talking about every day. We're rising on lighter volume. The
yeah,
rallies have been coming on lighter volume, and the heavier days have been sell-offs. And that seasonally February is weak. Well, February has been phenomenal for the longs this year, and that the advanced decline line isn't supporting it, and it's got to fail for all these reasons. And those are things that
yeah.
I'm aware of, and I'll keep them in the back of my mind. But it's not going to prevent me, and it's going to get me cautious when we're below that 5-day moving average because I'm thinking, well, if NVIDIA missed, we would have done something like this. So rather than have that uncertainty and the possibility of loss, I'd rather be out and then get back in right here and ride that little trend and get involved in Nvidia today. So it's about time frame, and people really have to recognize that too. I'm not running billions of dollars. I don't have to, you know, make the turns. So I don't have to be 2 weeks before the market tops. I can be 2 days after the market tops to be out. Hmm.
Yeah. Now, this brings to mind, the concept of handoffs, right? Because you have to kind of you know, trade around the trend. I understand, especially for the folks who are doing it short term or doing it intraday. The Brian strategies, help you have a game plan for that without turning it into guesswork and having regrets, right? Regrets the worst. Like what happens when you're in a winning trade? If you bought the breakout when Nvidia broke out at 505 or whatever it was, and you took $50, $60 out of the trade, that's a great trade, right? A thing moved 10%. Congratulations. But if you look at where it went, because it ticked up to 800, 750, whatever, it still moved another $200 afterwards. So it's not something you can feel good about, having left the majority of the money on the table. And you only need 2 or 3 really big moves in the year to kind of make your year. You know what I'm saying? So if you don't have a strategy on how to re-enter, there's a chapter in the book that talks about handoffs. I don't know if we have time to get into it now, but it's very complete, process. If you don't yet have your own
Yeah, it's
trading
basically
edge
where a
or
new
trading
momentum
style,
campaign
I would
begins.
suggest that you
So
look
if
at this.
we
It's very,
have,
very
for
valuable
instance, this
information.
is where that last one really began. Now we have,
Okay.
it didn't, and what we'll often see is that the market will pull back down and touch that. Instead, we stayed above the rising 5-day moving average. I got involved actually, Michael, at 521.50 over here. Sold some
Mm-hmm.
that very first day at 530 to reduce my risk. I sold another third somewhere, I think over
Mm-hmm.
here, I think maybe on this day, right here. And then 681 or so was the final third. I don't remember where it was, but something like that. So I sold, took a third here, which looks like I gave it away, but you don't know what's going to happen, right? The second third up in this area, and then the final third there. And then,
Yeah.
that's my way of getting involved. But where do the new momentum campaigns begin? It doesn't always have to be an exact touch of the prior VWAP, but here you can see we had a gap down and then the market rallied. So that was a new momentum campaign to measure risk against. And NVIDIA has been just so strong that we can't use that as a good example. Maybe CRISP, that's been a good one recently. I actually gotten involved in CRISP here and sold it at the anchor
Right.
from the all-time high, and missed some, but got back involved. And now I'm out. I got involved over here, but I'm trying to. So this is where this momentum campaign began, right here. Okay, let's go to a 15-minute time frame so we can see it more clearly. So that began
Mm-hmm.
right here on this day pretty much. Well, then we came back and touched it and a new campaign began there. So from the touch and the handoff here, now the
Yeah.
sellers have regained control from that point. But from this point, they're still in control. So if you're in later, somewhere in this area, you should be taking profits as it breaks below that. But if you're in from here, maybe you're raising your stop. Maybe your stop is still under this higher low and you're waiting for this to put your stop under that higher low if it rallies from there.
Yeah. So what Brian's kind of saying in a macro sense is that this can give you a trading system
Right.
if you look at and you know how to set your anchors. The market, as I've said it, the market will tell you when the move is over. You don't necessarily have to think about price targets yourself. You can let the market tell you, even if you studied reversals outside of Anchored VWAP. It's very, very valuable information. So, Brian, man, really a lot of gems here. I appreciate everything that you know. The book is
Right.
great. I'm starting to incorporate more of it into my, again, I don't necessarily want to be a day trader, but again, I have to execute. I don't get to sit on my hands and boohoo stuff because the market's not necessarily amenable to my longer term position trading style. There have been for a few names, but not really. So thanks for coming back on the show. I'd like to have you on again. Maybe one day we'll live stream something. That would be a wicked
Sure.
pisser. I haven't done that yet, but
Okay.
I want to try it. You'd be a good guy to do that with. We could talk
Likewise.
about what's going on in the market in real time. See how that works.
All right, Michael.
But
Great.
continued success. I appreciate you being here again, and I'll see you again soon.